All right, this is Brian with Black Arbs, Alpha Lab Research, and today we're going to be deconstructing a failed strategy. Was anything worth saving? This is a forensic reconstruction or deconstruction, really, of a strategy we're going to call Corrfilter. It was stopped in 2025 after performance discrepancies undermined confidence. Those are discrepancies between the original strategy before I deployed it live. Or let me say, it was being forward tested live, but then I deployed it in an automated fashion, and then there were discrepancies. 55 distinct market stress periods were examined, and one statistic kept hiding two opposing signals. And 18 different portfolio designs were locked before a 2022 validation set. And unfortunately, all 18 lost to SPY. So let's see if we can salvage anything from this experience. So quickly, the thesis, the Corrfilter itself was not worth saving, but its failure revealed a safer allocation rule, and it proved the research process could be trusted. So the safer allocation rule, and we'll see how this shakes out later in the presentation, but hedge quality in this case may reduce the proposed TMF position, but it may never increase the leveraged equity exposure or the risky exposure in the strategy. The research process that we could trust basically goes like this. Every allocation, return, and benchmark became traceable to an experimental run. The deconstruction traced the failure from signal design all the way to capital allocation, and a strict train validation test split let us reject the strategy and validation before burning the pure unseen test set reserved for one final use. So what is the Corrfilter? The Corrfilter in 1 minute, a rule for deciding how much leveraged market risk to own. So what was it watching? It was watching UPRO, TQQQ. These are leveraged U.S. equity funds, 3 times leverage actually. TMF, which is leveraged long treasuries, and one other hidden asset. And it measured how these assets move together. And what it decided was a single correlation pressure score that decided how much of the portfolio could remain in leveraged assets. So essentially, more correlation was perceived as danger, and it meant less money in leveraged assets and more money in shy and or a cash derivative or something like that. In this case, it was shy though. So while we reopened it, the reported results could not be trusted consistently, but the underlying question remained useful. When do several positions become one concentrated equity bet? So, and then to further highlight, it was not a market forecast, so to speak, but really a portfolio risk rule. So this research is investigating whether there was any part of that rule or process that deserves to survive. Section 1. Before testing the idea, we have to prove the evidence. Can every return, allocation, and benchmark be traced to the same run? So this is key for any research process. We need to be able to trace the evidence chain all the way through from hypothesis to results and every intermediate step. Initially, some of the bugs that had to be worked out, there was a missing benchmark. So if the leverage ETF strategy using Corrfilter could not beat SPY, the signal is not worth the added complexity. But there was some runs that didn't include the benchmark, so we didn't know. There were other problems, missing actions. So the strategy would generate daily target weights, but the reporting layer would drop part of the record, so we could see the performance, but we couldn't trace it to the actual portfolio decisions that produced it. That's a big one. Then we had a problem with mismatch benchmark. So this is the evidence chain. So we would run the benchmark. We had a benchmark, but the IDs could not be reconciled. So we couldn't attach the benchmark to the particular run. So that could have allowed the system to look at a benchmark reading from a different run that actually was over a different time period and compare it to the experimental run from a different period. So that had to be fixed. That was only one of the broken links. So there was some additional architectural, or not necessarily architectural, but code problems in the back end. So when the platform was upgraded, Corrfilter was not. So the current system was rejecting some of the files that were needed to run it. It could not read some of the results. So the backtest would actually run, but the results were output in an old format that the new version was not reading. A wrong interface. The strategy and reporting system disagreed about what a portfolio decision looked like. So valid allocations disappeared, and the application displayed analysis that the strategy never created. So that's another big one. So the idea is that the same strategy identity, the inputs, the decisions, and the returns had to survive intact from launch through the final report. So once all of those things were reconciled, fixed, and verified, we moved to section 2. So now we can actually get into deconstructing the signal itself, understanding more about what was happening under the hood. So the evidence held, but we found that the signal still mixed two opposing facts. So splitting them looked smarter, and we'll see if it improved the signal or merely added risk. So this score that we were using, or that I was using, was answering two different questions. So equity co-movement, it was asking, are the risky holdings becoming one crowded trade? And then it was also looking at the TMF hedge quality. Is treasury exposure behaving like insurance? So the legacy statistic average these facts together, and we'll see that in a visual later on. So what was the problem? Well, the problem is in 2022, this is where we found that the signal itself was conflating two different and opposing ideas. So during this period, equity pairwise correlation was very, very high in this portfolio, right? 0.925. The equity stress value was 0.861. These are all very high. But the hedge quality was very good at this point. So the hedge quality was negative, almost negative 0.6. And that translated to a hedge quality of almost 0.8. But when we mix those signals, we get a mixed signal pressure reading of negative 0.4, which is basically saying that everything is okay, right? And so we can see in this visual, I'll try to articulate it, but essentially we can see the top subplot shows the equity stress very high, very elevated for this time period. The binary signal that translated that stress score into, diversifying from risky assets into the hedge asset or cash asset, or the cash proxy really, which was shy, was basically turned off during the entire drawdown of 2020 until almost the bottom, where it flicked on, and then it took another risk on position near the bottom, which is not too bad. and then it turned off again. So we can see that the actual equity risk was warning of this problem early in the drawdown, but because of the mixed signals, the binary signal did not fire. And so we can see this again. You can review this on your own, but basically this is saying that the higher equity stress ranks preceded weaker returns, and the higher hedge quality ranks preceded stronger, longer term returns, right? But if we look at this little gray signal or this gray line here, which is basically in the middle of these two, you can see how it's basically compressing these signals towards zero. So even if equity stress is warning us, there's no position being taken because the hedge quality is pulling the average up, pulling the mixed signal up towards zero. So we do nothing. Okay, so the old score let good insurance hide rising equity danger, but the hedge was still working. The old score averaged both, and so the useful hedge offset the equity warning inside one number, and the combined signal could stay quiet while equity concentration remained high. So as a result of this, we had a little research side quest, where I wanted to look a little bit more in depth at this particular regime, right? Where the regime where we have high equity stress as well as good high hedge quality, right? So we traced every 2018 through 2021 period when both conditions were high. And I wanted to see, was there anything unique or anything we could take away that would salvage the signal or the strategy or anything that we could take forward to future research. So looking at this image, we could see that the conflict or this conflicted regime would usually start with a small gain on the day that it entered the regime. Now, this is not tradable because it was observed at the same time. It was observed at the same time, right? In the sense that we were looking at the returns of that day, right, at the close of the day. So it's not something that could be traded. So at that point, you're looking at, okay, what about the persistence? What would happen over time? And you can see that overall, it was really mixed. So we had some really deep and prolonged drawdowns. We had some that were able to recover shortly, but nothing that really generated consistent patterns that we could try to take advantage of. So looking at this note, 17 of the 24 paths rose on the first day. They averaged almost 1% gain, but that return had already happened when the state became observable, and then from there they diverged sharply. So would waiting for the conflict to persist filter one-day noise and isolate the longer deterioration? And let's see. Waiting did not isolate a clearer warning, so acting immediately, waiting for two sessions, waiting for 3 or more consecutive sessions. They all had the same type of return in the beginning. And then in terms of what would happen over the next 20 sessions, it was essentially unchanged or worse in terms of the returns, around negative 4.7%. So timing could not rescue a score with 2 jobs. So there was nothing to be seen from this little side quest. So we move forward. We go back to the main research path, right? So the idea is, now that it cannot rescue the score, let's split the score and let's see if we can find a better way to translate equity stress into leveraged exposure, and let hedge quality determine determine the exposure to the hedge, right? So we came up with 6 rules. How much leverage equity risk should stress permit? So we had the same inputs. Each rule received the same equity stress reading. Hedge quality no longer canceled the equity warning, right? These are split now. One variable, only the mapping from stress to permitted leveraged exposure changed. And these 6 rules expressed 6 different sizing responses. Everything else was fixed. So same 1-day delay in terms of entry. We use inverse volatility inputs, same cost and accounting assumptions, and portfolio construction. So this was a controlled sizing experiment. 6 exposure rules, not 6 signals or 6 standalone strategies. So now I won't go too deep into this, but if you decide to look at this on your own, basically this is how we split up the different rules and what they, how they translated the stress score into exposure weights. So the redesign. At first, the redesign looked smarter, right? If we look at the chart, the cumulative net return increased, almost doubled, and the geometric Martin ratio, which is just a risk-adjusted ratio that looks at compounded growth rate over the Ulcer index. So Ulcer index is basically a measure of prolonged drawdowns. So the longer and deeper a drawdown, the worse it is, the worse the metric is. And so we can see that both of those metrics improved. But what also changed was maximum drawdown doubled practically. And then we see that the average equity weight also almost doubled. So was it really more intelligent, or was it just longer equities, or in this case, longer leveraged equities? So we saw that, or I saw that, investigated it. One rule looked spectacular, and so we locked them before validation. So already, we can see that there's some discrepancies in this redesign rule, but we have the validation set. This is what it's for. If it's really bad, or is doing something that is really unexpected, which it was, it'll be revealed on the validation set. And so we can see that all 6 rules got wrecked. Now we look at the cumulative net return. All of them worsened dramatically for the most part. Maximum drawdown also increased. So we can see that during this period that the cumulative net return was basically almost equivalent to the maximum drawdown. So this was just a tough period overall. But the fact that all 6 rules were worse lets you know that there was definitely something systematic that was wrong. So let's take a look and see what changed in the allocation. So what we found in this failure mechanism was about 22 percentage points moved from shy into leveraged equities. So now instead of that allocation being moved between TMF and shy, it all went to UPRO and TQQQ. And so that was the source of the returns as well as the risk adjusted returns during a favorable period. But when the period is not favorable, you see what happens in terms of the max drawdown, everything just worsening across the board. So that had to be fixed. So what do? Now we're in the next section. Validation found the real mistake, and the redesign had moved the equity capital. So now we have to fix that, right? Fix the allocation logic. So let's leave the equity exposure unchanged and reduce only the proposed treasury hedge. So now we're not going to allow rejected TMF hedge cannot increase UPRO, and it can't increase TQQQ allocation. It can only increase shy. So it cannot exceed its original proposal, and any weights that are not allocated towards the hedge can only go towards a cash proxy, or in this case, shy. So let's see, was there any improvement between the previous broken redesign versus the fixed redesign? And we can see that it did. It improved across the board for all of the variants, but unfortunately they still did not meet the benchmark. So we can see that SPY did pretty poorly during this period also, with the benchmark printed on the chart, but none of them were able to be within within 2 times the SPY benchmark. So here the net return over that period was negative 20% roughly, and the closest we got was the old mixed signal at negative 40%. So that was good in the sense that we saw that we got the improvement once we fixed the allocation rule, but nothing in terms of being able to save or salvage the filter itself. And then maximum drawdown, same pattern here as well. And so then, we bootstrap the results of the, this is looking at the geometric Martin ratio. So this is the risk adjusted return that I like to use. And we bootstrapped it to try to get some confidence intervals. And we could see that all of the variants were all strictly below 0. The old mixed signal actually had more variation, which is kind of interesting to me. And the SPY was really wide. So overall, nothing we can take from this to take forward. But the analysis was very clear about that. So reject and protect. Repairing the boundary improved the answer, but it did not make the strategy investable, unfortunately. So we reject the candidate strategy, we preserve the process, and we protect the unopened holdout data. So let's take a look at this. The current conclusion. The research process survived, right? We hardened the research process, able to fix all of the bugs. We're able to fix the traceability and the auditability of the runs. We were able to fix the logic and the allocation logic, right? So when we look at audit, one evidence chain tied source data, allocations, returns, and SPY to the same run. The repaired pipeline launched, rendered, and reproduced a real signal candidate, and bad evidence was fixed before performance was interpreted, all critical. The next step was to isolate, right? Equity stress and TMF hedge quality were decomposed before the capital was moved. The in-sample redesign looked smarter, but that was only because it was more exposed to more risk during a favorable period. So we had to update the architecture. And then finally, the gate, right? So we used our validation data to reject all of the redesigned rules And what else? Then we corrected the allocation logic. That helped. But it still trailed SPY by 21 percentage points. And so no candidate earned access to the true holdout data. And that's critical, right? Because we can only use that holdout data one time. So what would we have had to have seen or do, in my opinion, to have earned that right? That's what this slide is looking at. So first you have to define what you or your investors need, right? So in this case, I was looking for a maximum drawdown near, it doesn't have to beat, but it has to be close to the period match SPY benchmark. That was my target. There's also a hard drawdown ceiling as well. In this case, it's probably roughly around 30%. Around then, it becomes really hard to hold through the drawdown, just psychologically. And we have to make cost and recovery time part of the pass or fail decision, right? So again, if you are benchmark versus SPY, and SPY is in a drawdown, and the strategy is also in a drawdown, and they're pretty comparable for, on a risk-adjusted basis, then that's okay. But, or, if your strategy is down more, but it's still outperforming on a risk-adjusted basis over a longer period of time, that's okay. But if, for example, your strategy is down or down a lot, it's benchmark versus SPY, and SPY is up, and that drawdown is 6 months, it's generally you're not gonna persist with that strategy, even if it's automated. So then you have to prove that the strategy earns its complexity, right? So we would have to look at the daily correlation beta, downside beta to the benchmark. In this case, it was SPY. Test the drawdown overlap, active return, tracking error, and recovery, and also compare against unlevered and partially leveraged controls. And then finally, you'd have to protect the final answer. So you would you'd lock your signal, the allocation rules, benchmark, and all of your thresholds before moving forward. And so obviously logging that, writing it down, encoding that before your final holdout set, that would be the key. And again, you can only use that final test set once. So it's critical that your strategy or whatever you're doing passes all of those rules ahead of time, because once you see that out of sample result, you cannot tune the strategy again. So, conclusion. We're not able to rescue the Corrfilter, but we proved the pipeline could repair the evidence, expose leverage disguised as alpha, and reject the candidate strategy before opening the true holdout. So audit, isolate, and gate.